G'day and welcome to the quarterly investment update. My name's Tom Elliott, Director of Beulah Capital. With me is Beulah's CEO, Christian Ryan. And look, it's safe to say that the last month or two, particularly October, have not been good for markets. There's been a looming fears of a trade war between the US and China. There's been downgrades to earnings, particularly amongst financial stocks in the wake of the Hayne Royal Commission here in Australia. And share markets have been pretty ugly. However, we've been putting our heads together to come up with a few positive ideas for the next few months and into 2019. Christian, what have you thought up?
Yeah, well, Tom, look, October wasn't a great month, and I think there's a lot of always, especially in the media, speculating about a lot of doom and gloom. I think as investors, it's always good to look at sometimes, the positives. So the two for me that I think investors should have a look at, through 2019 is focused around two areas. Firstly, technology investments, and the second one, which is probably relatively new for investors to think about, is alternative lending. So I'll just talk a little about alternative lending first. As many of you aware, and probably reading through the papers, is that the banks have become really, really tight on lending to people, to investors, to developers, and to some extent, probably almost creating their own credit crunch. And interesting enough, this morning the RBA, in its latest statements, are saying, well, hang on a sec, maybe the banks need to pull back a little bit and actually be a bit more considerate or flexible and not get too tight, because it could actually create some unintended consequences. So when a big player pulls out of the market, there's plenty of other smaller guys, or even medium-sized businesses, super funds of the like, that are now coming in as lenders, to property people. So alternative lending is probably lenders that are lending to commercial and residential investments and attracting a really good return for investors, secured really conservatively against house residential projects, residential property and commercial assets. Typically, these types of groups are probably only lending to 60% of an asset value. Why I think that's a positive outcome? One, it keeps cash or credit flowing to the people that really need it. There's a lot of great businesses out there that are doing a really good job, and banks are just closing up shop too tightly. Yet we have great projects, great businesses in small to medium-sized businesses, even large businesses around Australia. So I think, one, from an investor point of view, it's a great opportunity to get probably a higher return than you might normally get for some of these types of things. And two, I think it actually creates greater competition for the banks. So these types of lending are becoming more and more common. The opportunity to invest in these things are becoming more common. They're not like the old mortgage trusts back, pre-GFC. A lot of these structures and things that you can invest in, a lot more liquid and more things that you can get into. So I think that's going to be a highly profitable investment opportunity over the coming years.
And just quickly, you mentioned technology investing. Is that just going after the big ones, the so-called FANGs, Facebook, Apple, Netflix, Google, or is it looking at other types of businesses?
I think, from my perspective, and this is not just a 2019 investment strategy team, I think it's a very long-term investment opportunity for investors. Technology is not going away. It's changing businesses, it's changing large, small, it's changing everyone. And it's really taking the opportunity now at the moment, where there has been quite a bit of a sell-off in a lot of these larger, mega type of stocks like Facebook, Google, Alibaba, Samsung. A lot of these technology businesses have been sold off pretty hard, and look, probably rightly so to some extent. They've had some pretty hefty valuations on it, but I think long term, if you can hold some really good core basket of these large technology businesses that you can pick up potentially through this period of time, you sat back here in 2, 3, 4, 5, 10 years time, these businesses aren't going away. They're growing at 20-30% a year, and I think that's just going to keep happening.
Okay, well, I've got three ideas. The first is interest rates. Now, as Christian said, bank lending is probably going down in terms of volume. I have a funny feeling the Reserve Bank might actually be forced to cut interest rates next year. Housing's going through a bit of a crunch at the moment. I reckon they'll realise that they've cut back the bank lending a bit too far. So that's one idea. Second one, I read the Myer results the other day, and Myer is looking in not very good shape at all. Online sales were down. They say they're up, but they include it when people pay themselves on an iPad in the store. I don't count that as an online sale. Store sales were also down, But I reckon people are still spending money, and a stock you might look at in terms of those big tech stocks is, of course, Amazon. Because I mean, Amazon is not only selling things itself; it is the back room for lots and lots and lots and lots of other retailers or e-tailers around the world, and of course here in Australia. And my other idea in the wake of the Victorian election, it actually doesn't matter who gets elected. There's going to be a lot more freeways built around Melbourne, and that's really good for Transurban. So Transurban, I guess, is my other pick. Okay, well, thank you for listening. I reckon hopefully the nervousness of October and early November is over and done with. Of course, you never know, but there's a few positive ideas for the future. Talk to you again very soon.
Thanks, all.